Okay, so let's take a look at gold. The price of bullion is under pressure again today after falling more than 6% yesterday, which was the worst decline since 2013. That drop was driven by profit taking after a lengthy rally, an easing of U.S.-China relations, and a stronger U.S. dollar. For more on gold, we're going to bring in Carey MacRury, analyst at Canaccord Genuity, with more. It's good to have you join us. Thanks for taking the time.
Thanks for having me.
So gold prices hit a record high on Monday. Then we saw that really dramatic drop yesterday. As I mentioned, it's not just one factor, right? Like, what are you looking at when it comes to what we've been seeing with gold over the last 24 hours?
Yeah, I think it's important to keep in mind that, gold has been extremely strong this year. I mean, we only hit $4,000 an ounce literally 2 weeks ago. Even with the pullback, gold is up more than 50% year to date. And, that's the best year for gold since 1979. So we think after a really strong run, particularly in October, gold was up almost $500 an ounce just this month. I think it's just a natural pullback here.
So do you think what we're seeing right now, the pullback, I think you touched on it right at the end of your answer, is that kind of short term?
We think it's short term. I mean, if you look at the fundamentals for gold, we think they're still strong. You've got the Fed cutting interest rates. You've got a slowing labor market, obviously with not a lot of data. The Fed's sort of flying blind right now. You look at the U.S. debt level; it's at $38 trillion and climbing at $2 trillion a year. It's 6 to 7% deficits in a growing economy is literally unheard of. So I think there's a lot of macro factors. Then ultimately, central banks continue to buy gold at record levels. You think about the assets that central banks hold. They hold $16 trillion worth of assets, and gold, its share is increasing and the U.S. dollar share is decreasing. So we think all those factors are still in place, and we think that'll ultimately take gold higher.
Okay, so then, I've heard some analysts talk about the fact that they think there's like a bit of a bubble right now with gold, right? Where that bubble's been getting larger and larger and it's finally popped. You don't see it that way?
I don't see it that way. I mean, to put it in context, gold was $35 an ounce in 1971. Gold was $250 an ounce in 2000, and here we are at 4,700 per ounce. I mean, at the end of the day, the supply of gold is very slow. Mining is very difficult. The supply of gold increases by about 1.5% a year, and that's been the rate for 50 plus years. The supply of dollars goes up by 6, 7, 8% per year. So in the long run, it's gold versus dollars, and we think gold goes up in the long run. So, we talk about bubbles. Is $38 trillion of debt, is that getting any smaller? It's not getting smaller. And again, it's growing at $2 trillion a year. That debt number is up 50% since the end of 2019. So, gold is rising in response to these factors, and these factors are not subsiding anytime soon that we see.
Okay, and on that note, you did raise your rating on Franco-Nevada, which is basically a gold investment company. You raised that from hold to a buy. Can you tell us more about why you did that?
Yeah, so Franco-Nevada is a royalty company, and as a royalty company, it's generally a safer way to invest in the gold space. They don't operate any mines. They own a percentage of the top line revenue. It's one of the best royalty and streaming companies out there. We took advantage of this pullback. The stock is the valuation is more reasonable here, so we took advantage of this pullback to upgrade what is a high quality stock that has a great track record of growing its share price value. Is
that what you think maybe investors should be doing right now? Now that there's a bit of a drop, as you say, you took advantage of it to kind of buy a little bit more. Is that? I mean, obviously it depends on the company, but is that something that investors should be keeping in mind in terms of a strategy?
Yeah, no, that's a good question. I mean, for investors who want to be defensive, and certainly after a big pullback, it's natural to be defensive. The royalty names are a classic place to be. You don't take on a lot of capital risk and operating risk, so they tend to be less leveraged to gold, but over the long term have performed very well.
Are there any companies at the moment, when we're talking about gold or even just precious metals, that you're cautious of?
I would say the answer is no. And the reason I say that, if you think about the last cycle, and this is sort of like 2000 to 2011, companies, even 2011 was a year of record prices. Companies were still spending more than they were making, and they were accumulating debt. You look at the market today, companies have good balance sheets, they're paying down debt, they're making lots of free cash flow. So fundamentally, the sector is in a much different place today. I'll give you an example of Agnico Eagle. They're one of the best, quality operators out there. They have an $80 billion market cap, and they have only about $600 million worth of debt. They've been paying down debt, and they're making $5 billion a year of free cash flow. So here's a company that's paying down debt, they're paying a dividend, they're buying back stock, and they're still generating cash. So I think the sector is in a much better place. So we don't really have any outright negative views on the sector here.
Just on that note of Agnico Gold, right? Because that's one of the big ones on the TSX that was kind of dragged down yesterday with the price of gold slipping so much. What are your thoughts on how the TSX has been affected by this drop?
Yeah, so if you look at the gold sector as a percentage of the TSX, I think the average is something like 8 to 10%. And certainly given the strength this year, it's now pushed up to sort of high levels. It's around 14%, and it's been as low as 6%. So certainly gold's as a percentage of the TSX is as high as it's ever been. We think it can still go higher. At the end of the day, the gold industry is a global industry. It's not necessarily tied to Canadian fundamentals, but certainly for money managers who are managing Canadian money need to pay attention to the gold space.